Holistaplan presents Tax Time with Jeff Levine. Let's talk taxes.
Welcome, everybody, to the next episode of Tax Time with Jeff Levine. I am clearly not Jeff Levine. I am Ben Birken, the Vice President for Customer Success and Engagement here at Holistaplan. Once again, filling in the shoes of Roger Pine, which is complicated because he's got very narrow feet and I do not. So it makes stepping into his shoes complicated for me and painful, and it bothers him because then, of course, he has no shoes. But that's enough about that. Jeff, it's good to see you again.
Good to see you too. I like the introduction today. It's good.
Thank you. Trying to mix it up a little bit. It can't always just be the same thing, right? And frankly, it's really just me pushing down my anxiety in anticipation of tonight's NCAA championship game, which I realize once this goes out into the world will have already happened. But in the event that it does anything karma related,
could you believe that? I can't believe that. Kansas won. That was amazing.
It was a remarkable effort by the UNC Tar Heels, right?
That won, yes.
That's right.
The team that hit the baskets was amazing.
Oh my gosh, they scored. Okay, so yes, we're just kind of to quell that anxiety, and so instead we'll be talking about something completely unrelated, but having to do, I think, with some changes that some folks obviously go through every year, but impacts to your filing status as it relates to changes in your family, right? So I thought we'd start that because there are some things that you're going to need to be made aware of, and maybe some changes you need to make, or at a bare minimum, stuff you need to know, right?
Sure.
So let's start with the simple one, the happy one. You're single, you go from single, you found the person with whom you're going to spend at least some portion of the rest of your life. And so you're going to change from filing single to filing typically like married filing something, right? Mm-hmm. Married filing jointly or married filing separately, but something different than filing as a single filer.
That's right. And of course, which of those you choose can have dramatically different consequences, right? Married filing separate, we'll start there, even though it's the less common one, but because it is probably the one that would have more severe changes that you'd need to know about. There are a variety of benefits in the tax code that married people who are filing separate are not entitled to, things like premium assistance, tax credits, or whatnot. A whole slew of things designed to prevent abuse, right? Because ultimately there is the quote unquote marriage penalty for some high earners who get married. And in a way to try to mitigate that, sometimes people will file separate, and so to tamp down that abuse, there are a whole bunch of things in the tax code that go away when you file married separate. Now, for most couples, though, it's married joint, and the things you want to be aware of too are, again, it's two people coming together in life and in love, but also two incomes, two sets of deductions, two sets of credits coming together on one return. And so in some cases, that might be really helpful for individuals to file married, joint returns, because they have somebody who's a very high earner marrying maybe someone who is a more modest earner. And so the joint brackets now are pretty nice, pretty big and juicy, because some of that high earner's income now gets pulled towards the lower brackets. By contrast, though, sometimes you'll have someone who was maybe single and they were getting a nice big QBI deduction, but now because they marry a higher earner, they're phased out of that deduction, or they're phased out of certain credits that they were getting before. Ultimately, whenever there are changes like this that occur, doing kind of a pro forma, not so much to decide whether you're going to get married or not. I mean, ultimately, I think most people are not deciding whether to get married or not because of tax planning, although I have certainly seen people decide to get married on like late December, or decide to do something early January, like that I've seen. But it's not like, hey, we're never going to get married because this is going to cost us more money. Most people aren't that concerned about the numbers. The love is more important, but knowing what it's going to do, right? If between the two of you, it's going to cost you another, $3,000 or $4,000 of taxes a year, that's important to know. And similarly, if it's going to lower your tax rate by a few $1,000s, that's also worth knowing as well. It's money back in your pocket. Maybe you can afford to contribute more to a retirement account each year, or put more money into your plan to get a bigger matching contribution. All of those things are important, and knowledge is power.
Absolutely. So we all know you can't put a price on love, but you can pay more taxes in some cases, depending on what that love looks like. I will say that one of the things that I'm aware of when I'm working with my own clients when they've gone from single to married is changing their W-4s, right? So if they're used to withholding at a single filing rate, they might be over withholding relative to what their ultimate tax bill is going to be.
Absolutely.
Right. So that's the happy way. Let's talk about not always the unhappy way, but the
I was
unfortunate
gonna
way
say, for some people, I know
Yeah.
this is the even happier way.
Yeah, right. Like let's just not put a value judgment on it, but let's go backwards, right? So we are married and now we have divorced. And you said a couple of things in your earlier sentence, in your earlier answer, that I think are worth noting. Does the IRS care when in the year you get married?
No,
No.
at least not for the most part, right? There are some things that are you're required to have as of January. For instance, if you are marrying a much younger person, more than 10 years younger than you, and you had required minimum distributions for the year, can only use the joint table. You're determined married whether you're married on January 1st. But for most things in the tax world, you get married or you're married or divorced based on your status as of the instantaneous moment before the stroke of midnight on December 31st. So you're single for the entire year, and all of a sudden there's a countdown on the wall: 10, 9, 8, 7, and the minister or the clergyman or the official at the courthouse, whoever it may be, says, "I now declare you man and wife," or husband and wife, or husband and husband, or wife and wife, or whatever it may, like, "I now declare you a married couple." Fantastic. You are, you got in there right before the stroke of midnight. It's as if you were married the entire year for the overwhelming majority of purposes, including what your filing status is on your tax return, etc.
I have to believe that out there somewhere, there is a CPA couple that got married right before the stroke of midnight just for that purpose. I hope that's true. Just for my own benefit, I hope that that's true.
I've
So
got a good
let's
story I'll share with you offline one of these days.
okay. All right. So let's work backwards though. So we went from single to married. Now let's go from married to single by way of divorce, because I want to talk about married to single by way of death a little bit differently, right? Because there's a few other things that go on there. So let's go from married to divorce. What are folks
so
need to be
married to
aware of?
divorce, you're probably, first off, the question is, what filing status are each of you going to take for the year? And that might change, right? Because in some years, like for instance, some divorces, there are no children. It makes things a little bit easier from a filing status perspective. But if there are children, perhaps somebody's filing as head of household. It could be that on alternate years, different people are taking that because you are, it could be alternate years because you are changing the dependency status each year or something like that, or shared, different custody arrangements or whatnot. So there are those types of things to consider. Obviously, if you can't file head of household and you can't file married, certainly not a qualifying widower in this case. So there's only one thing left, and that's filing single. And it's basically the opposite of getting married, right? We talked about there are some good things and some bad things about getting married. Well, there can be some good things and bad things about getting divorced from a tax perspective. Certainly, if you are the lower earner, you might see your income go down, rather your tax rate go down. If you're the higher earner, you might see it go up. And it's worth noting too that since 2019, right, the Tax Cut and Jobs Act has had this prohibition on the deductibility of alimony, and overwhelmingly, and for obvious reasons, the higher earner tends to be the one who pays the alimony. So that's a really big deal for couples that are getting divorced, because not only is that higher earner now still paying the tax burden on that income, but they're paying that amount, but they're also paying the tax burden on it. It's like a double hit to that individual. So for a lot of couples, it actually has lowered the amount of alimony that individuals will pay, because the courts will take into consideration in many instances the tax impact on the giver, right? And if it's not deductible to the higher individual and taxable to the higher income individual, to the lower income individual, which would shift taxes to a lower amount, well, that delta, right, between what it would have been taxed at the higher or the lower earner versus the higher earner has to come from somewhere, and the courts have to apportion that. And in many cases, it means both individuals will end up with net less dollars.
Yeah, it's I know that threw a monkey wrench into a lot of folks, just concepts of what that might look like if you're basing things on that older way of, well, at least it's tax deductible and the receiving spouse has to pay taxes on it. Well, that's gone now.
2018 was a very busy year for my divorce attorney friends.
I can only imagine. So let's talk then about the last of what, at least the last of most of these filing status changes, which is going from a married couple to one person in that couple dies, right? So now you're in a survivorship situation. What does that look like?
Well, the year that it happens, it looks exactly the same as if the person had lived, right? Because we can continue to file a joint return during that year with the decedent, provided the survivor doesn't get remarried during the year, right? But assuming, married couple, one of them passes away today, this would become the last year of a joint return. Going forward, now the question is, what does that survivor, what would that survivor's filing status be? If there are no children involved or anything like that, then they're probably going to shift to single. If there are younger children involved, then a lot of times for the next 2 years, they can file as a qualifying widow or widower. Sometimes you'll hear that the technical name is qualifying widower with a dependent, a child, but we generally abbreviate it to qualifying widower. And that's the 2 years after the year of death. So, 40-year-old couple, sadly, one of them passes away and they have young children, right? A horrible scenario. That surviving spouse this year would file joint because it's the year of death. For the next 2 years, they could file as a qualifying widower. And then after that, we've got to go back and look again. So if there's still young children, maybe they're shifting to head of household. If there are no longer young children, then they would be single. But there is kind of this like 3-stage process, right? It's continue to file joint. Then if there are the children, go to the qualifying widower. Then if you still have the young children, you go to head of household. And then ultimately the kids grow up and you go to single. So you can kind of go through all basically, all 4 of the 5 filing statuses for some individuals in a short period of time.
And I'm just curious, the qualifying widower with children, across all of these, the brackets are the same in terms of the rates.
Yes.
Right. It's just the income that fills up those brackets looks different, right? I mean, there are other things too, but we're not looking at like vastly different, not different rates. Like there's not a 5% rate for a widower. We're still looking at the same marginal rates.
That is right. So effectively, when we're talking about like the different filing statuses, what we're really looking at is where do those rates begin and end? In other words, to your point, like we're not changing the actual rates, it's just how quickly do you get to those next rates, right? How quickly is it that you move from one to the next rate?
Yeah. I think, in thinking through my experience with clients, luckily I've not had too many situations where it's been young couples where somebody's predeceased somebody else, but thinking through some of my older clients who are on the retiree side, we're seeing not a dramatic change in income, but a significant change in the taxes. That has been, I think, a big eye opener to, unfortunately, many a widow.
Yes. We, I talk about that a lot in a lot of the sessions I do. Where we all talk about quote unquote the marriage penalty. But
right, you mentioned that in your first answer. I wanted to come back to that a little bit because I think sometimes that has gone in and out of vogue in terms of talking about a marriage penalty. So, I mean, we're here.
But the widow's penalty is also something to keep in mind, which is effectively what you're just talking about, right? If a retiree, oftentimes you're just dropping the lower Social Security check, but by going from the joint brackets to the single brackets, that survivor may have less income and a significantly higher tax bill on top of it.
Yeah. So, I mean, it's an unfortunate circumstance, but just something as you're planning for folks to be aware of. Tax bill could be beyond your control, but just when you're running those retirement protections, when somebody dies is really important. I mean, for them, obviously, but in terms of the longevity of a portfolio, the tax hit becomes significantly higher for the same dollars.
Yeah. Well, even in looking at things like, should I do a Roth conversion or whatnot? While you're both alive, you're buying the joint bracket. I know you're both alive right now today. So no matter what happens this year, if I convert, I can use the joint brackets. I don't know what next year holds. And so obviously at different ages, et cetera, there is more of a urgency to buy that joint bracket, but that's absolutely a consideration. All right, sorry, I took you off track. You're about to ask me again about the marriage penalty.
Well, I was just, coming back to the marriage penalty, right? I think that got tossed around a lot for a number of years. And then if I remember correctly, it kind of faded away, but now maybe is back, or help me understand, but first of all, what it is and like where it's going and
So
why do people think about it?
Yeah. So the marriage penalty is not really a penalty, right? There's no like, oh, you're married. Here's, 3% more for you. Sorry, but it is a tax phenomenon, if you will, where two high earners using the single brackets and all the credits available to single individuals and the deductions available, to, et cetera, may have a much lower tax bill separately than after they got married. I mean, just think about it conceptually from this point of view. Just a quick example, right? I am a single filer. I have $30,000 of itemized deductions. I'm marrying someone who has their $12,000 roughly standard deduction. Separately, we have $42,000 of deductions. But when we get married, we only get to have the higher of the standard, which is now higher than 12 or whatever, but 30 is still more. So the $12,000 deduction or whatever, my spouse's standard deduction now goes away. And together, we only keep my itemized deductions. Before, we were both able to take $10,000 each of state and local taxes. Together, we're only able to take $10,000 of state and local taxes. So the idea that by getting married, our combined tax bill is higher than our combined tax bill was before we were married, that's the marriage penalty. And I wouldn't say it's like gone away or anything, but the Tax Cut and Jobs Act changes to the brackets and nature of some of the deductions, like the QBI deduction, et cetera, really minimized the impact. For instance, if you look at the married filing separate brackets and single, like basically the same, right? So and the joint brackets are like double that rather of the single brackets at the lower thresholds. Once you get to like 35%, so if you had two people each earning, $700,000 a year, they're going to pay. We're talking about such stratospherically high income, that it's not as nearly as big of a deal today as it was years ago for individuals. That's not to say it's not an issue. There are other things. Again, I just gave you a couple of ones that apply still today. The $10,000 SALT cap has a true marriage penalty. It's $10,000 no matter whether you're single or joint. The losing someone's standard deduction because somebody else has like those are real things, but it's not as pronounced as it was, say, 10 years ago, or even 6 or 7 years ago before the Tax Cut and Jobs Act. Once the Tax Cut and Jobs Act changes, or the majority of them expire back in 2025, going into 2026, if nothing happens, the marriage penalty will reemerge as a larger issue once again.
I'm going to pretend you didn't say that just because it's going to make my life easier to live in a world where nothing sunsets and everything just continues exactly as it is.
Go for it.
All right, Jeff. Well, thank you.
You just need billions of dollars and start lobbying Congress people now, and it'll be no problem. It'll get done.
That sounds like a tomorrow problem, so I'll get on that tomorrow. But in the meantime, Jeff, thank you as always for your time. I always appreciate the insights that you have to share, and thank you to everybody who's watching. We will talk to everybody at our next Tax Time with Jeff Levine. Jeff, thanks so much.
Yeah, thanks for having me.